Welcome to Markets in a Minute. My name is Austin Duke. I'm financial advisor and chief investment officer for Diamondback Financial Services. We are a wealth management firm focusing on clients who recognize the need for solid financial advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, August 3rd, 2026 edition. Let's get started. Investment values fluctuate on a daily basis for a variety of reasons, and our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. Diamondback Financial is a long-only investment firm, so we keep your money invested in the areas that we feel offer the best opportunity for growth as opposed to timing the market. We will focus exclusively on the traditional investments of stocks, bonds, and cash, and so we will monitor changes in the stock market as well as interest rates to help drive our overall investment decision process. First, we look at the stock market as measured by the S&P 500. This is an index of the 500 largest companies in America. And over the past 2 weeks, we saw the stock market go up about 0.43%, which brings our year-to-date gain to 9.41%. Obviously, we ended about where we started, and for the entire month of June, we also ended about where we started. We got close to an all-time high a couple weeks ago, and then we saw a pretty significant decline as we were restarting issues with Iran again, and also some second quarter earnings for some of the larger companies in America did not do extremely well. So Wednesday here, when the Federal Reserve met, you can see there was a lot of volatility with their rate decision of leaving things unchanged, and then the press conference. And anyway, so that was a volatile day, but again, strong earnings from a handful of companies on Thursday and Friday, and some economic data led us to see a very strong finish. And where we had been down about 2.5% for the month just a couple of days ago, we were able to basically erase all of that and end the month relatively flat. If we look at a five-year chart, we can see that there's a lot of ups and downs, guys. Like the market goes up and down, right? We've basically been treading water, been pretty flat for the past couple months. The increase that we saw from the end of the quote unquote end of the Iran war until June was an unsustainable growth rate. So we could either go flat or we could go down. I personally would rather see a couple months of no change, right? Just kind of treading water for us to get back more on a sustainable growth rate. If we next move to interest rates as measured by bonds issued through the U.S. Treasury Department, we feel that interest rates really are the preeminent measure of investment risk. Rates are factored into every investment calculation, every valuation that's out there, including stock valuation. So generally speaking, if interest rates are going up, costs of business are going up, which leads to lower profits and thus lower stock prices. Vice versa, if rates are coming down, that lowers the cost of doing business, which can lead to higher profits for stocks and thus higher stock prices. Over the past 2 weeks, we saw decent gains in interest rates that mature over a medium to long-term time frame. We have our interest rates listed over here on the left-hand side, and we have maturity lengths listed here on the bottom. So each of these dots represents a bond that matures at a particular maturity and the interest rate associated with those bonds. So the brown line is where we were 2 weeks ago. The green line is where we finished here on July 31st. We got some funky things going on the short end of the curve, but for medium and long-term rates, after that Fed decision on Wednesday, we saw some pretty significant gains, which may suggest that market participants are signaling that they don't have a lot of faith that the Federal Reserve is serious about trying to lower inflation back to the 2% level that they would like to see it. If we look just at the 10-year U.S. Treasury, right, we've pointed this out before, we were below 4% before the Iran war started. We're almost up a full percent on the 10-year Treasury now, up almost at 475. Higher than where we were at the peak of the Iran war and everything from a few months ago. So, interesting times. This will also correlate heavily with mortgage rates. So, we've got friends that are trying to move and get settled in before the school year starts. And, I think unfortunately they're going to be getting a higher interest rate than they would have just a couple months ago. But, um, hopefully that will eventually come back to a lower level. But honestly, like, if we were to look at a 5-year chart of just the 10-year U.S. Treasury rate, um, we're pretty much averaging about 4 to 4.5 since we came out of the high inflationary period post COVID. So inflation went up, interest rates went up, and they've basically been pretty flat here over the past several years now. We'll call it 3 to 4 years. We're obviously in an uptrend at this point. 5% is the highest we reached back in 2023 before things started coming back down and getting us into this trading range. So could we get back up to 5%? Yes. Do we think so? Things are set up pretty well for this to get back up to a 5% 10-year treasury, we'd say by the end of the year, unless something changes. If the Federal Reserve maybe they do something to help get inflation to come back closer to 2%, or the market, people in the market are able to make the adjustments with the corporations or consumer spending, et cetera. So if we start seeing the economic data suggesting that inflation's not going to pick up again, then we could see the 10-year come back to more of a 4%. I think we would prefer to see it below 4%, but again, where it is now in a 4.5% average rate, and historically that's not high. For those of us in a post-financial crisis generation for the past 2 decades, right, like 4.5, 5%, that's a pretty high rate. But historically, pre 2008, 4.5 is not bad. That's actually a really good rate. So again, we leave the Federal Reserve rate unchanged, upper bound at 3.75%. We've got our probabilities of whether or not they're going to increase rates at future meetings. The next one in September, right now about a 72% probability that they will increase at that meeting. So again, unless the data suggests otherwise, likely that they will raise at their September meeting. Over 100% probability that they will by October. And right now, almost a 50-50 shot that they raise again in December. If we look at the spread for corporations that are funding their operations through bonds, this is an interest rate above and beyond a U.S. Treasury that corporations are paying to finance their debt. And right now, it's at very low spreads, which this gives us a little bit of a peek into what the market is suggesting as a probability of default for these corporations, which these spreads are very low, suggesting to us that there's not a lot of stress in this market at the moment. Because the war is back on, we want to just quickly cover oil and gas. This is West Texas Intermediate. Oil prices obviously spiking here as the war got started, and we had a bunch of back and forth between a ceasefire and resumption of hostilities. We had our memorandum of understanding that brought oil back down in June, and then resumption of activities or hostilities again here in July. We've kind of settled here recently in about $85 a barrel. But we're hopeful that we'll see some resolution. Not optimistic, but we're hopeful that we get something soon that sticks. This is retail gas prices, which obviously increased as we had some supply shortages in oil, peaking above $4.50 a gallon, and then starting a decline with the memorandum of understanding, and then with the resumption of hostilities, now we're settling in. We've been about $4.10 a gallon on average for the past couple weeks. That's pretty much where we are, what we've seen in the data, um, and where we think we've been, and now we can get into where we think we're going. All right, for our investment implications and expectations portion, it's probably going to sound like the same thing we've been talking about all year long. We we're up 9%, 9.5% in the market for the year, which is actually pretty good considering everything that's been going on. Um, we would still hold to our base case that we could go up another 5% between here and the end of the year. We think most of that would probably come post midterm elections, just when we get some clarity on the makeup of Congress. A lot of this hinges on what happens between the US and Iran. A lot of this hinges on inflation and the economy and whether or not the Federal Reserve is going to raise interest rates. If we can end the war with Iran, actually have an end to the war, and oil comes down and gas prices come down, that can help sustain the economic growth that we've received so far. But there's a lot of potential outcomes, and it makes it difficult for us to pinpoint anything at this point. But we would not be surprised if 3 months from now we sit down and we look at what the market did over the last 3 months, and we're basically in the same spot. Just a lot of volatility, a lot of sideways action. Which again, we're more in favor of sideways action as opposed to going down uh, from 1 month to the next. So yeah, I mean, our expectations are to stay invested. We can still get dividends and interest from investments while we go sideways. We can be happy with the 9% growth we've received so far this year, and expect that things will improve between now and the end of the year, and we'll get some more growth as well as the dividends and interest. So that's the strategy that we're employing. And gosh, if those 10-year treasuries get back up to 5%, then it may be an opportunity for us to do some rebalancing and lock in some longer term uh, growth, longer term interest that has not been easy to come by in the last 20 years. So um, I think that's kind of what we're thinking at this point. All right, as a final word, kind of a personal indulgence, and at the risk of upsetting all of my other children, I just want to take a moment to talk about my oldest son, Jonathan. He is on his way to college this fall in about 4 weeks, and we recently got him a vehicle so that he could drive himself down there and drive himself around while he's living on his own. I don't like cars. I don't like shopping for cars, especially. Um, they're expensive. They're expensive to maintain and insure, et cetera, et cetera. But there's something about a vehicle and sending your child off to school. Um, I don't know, just it gives you this sense of hope for the future, and you just I don't even know how to describe it. It's just trying to set these kids up for a better future than we enjoyed growing up. And so I think whether it's trying to get my kids, whether it's my oldest who has done some college and she's married and living off on her own and starting her own family, or it's getting these kids through high school and getting them off into adulthood. But you know, it's for it still kind of comes back to that American dream for me, and the reason why I like what I do, and I like finding businesses that we can invest in, and just identifying that hope and that perseverance that's out there. I don't know if any of this makes sense, but um, anyway, we are hopeful for the future. We look at these kids and we recognize that there's a lot of potential out there, and so we're happy to try and do what we can to get them off on the right foot. And we have that similar feeling with how we run operations here at Diamondback. And we're grateful for all the clients that we have. We're grateful for the opportunity that we have to sit and try to do what we do to increase the value of your account so that you can have confidence in your own futures and retirements and everything. So that's all we got for this week. Thanks for tuning in. Have a good week. We'll be back in a couple weeks to hopefully have something to talk about, and we'll see you soon.